So the next topic that we want to talk about is related to the assets type. When we were talking about money, when we are talking about wealth, we say that we are allocating our wealth between the monetary assets and the non-monetary assets. So then what can be the possible candidates for the non-monetary assets? They can be bonds, stocks, or others. The others can include the real estates, the lands, and artwork. So in today's lecture, we want to focus more on the financial assets related to bonds and stocks. So what is the definition for bonds? Bond is a debt instrument requiring the issuer, which is the borrower, to pay the lenders the amounts they borrowed plus the interest, which we call coupon, over a specific period of time. The information on top of a bond includes who issues it, when it will get matured, what will be the interest that you are going to pay, and how frequent you want to pay the interest, and what is the ranking of your claiming rights if the bond issuer got defaults. And then the return for holding the bonds or the value change of the bonds and the coupon interest that you are going to receive. From the discussion in here, you will notice that the bond is simply a debt instrument. So then before the introduction of the bonds, that is in the old days, if you lend money to someone else, you may want to write down a note and say that who you are and when you are going to return the money, by how much you borrow the money, and then what will be the interest. So then on top of a bond, similar information need to be listed. And somehow the difference between a note that you write versus a bond is that the bond is a standardized contract such that it will be able to have a secondary market that you can trade it, and then which means that you do not need to wait until it matures to get back the money. So for example, if you buy a bond issued by TSMC, which is $1,000, it means that you lent $1,000 to TSMC. So then in the old days, if you write a note and you lend your money to TSMC, then when you want to use that $1,000, you cannot get it back unless it's already been the time for maturity. But for buying a bonds, if you buy the $1,000 bonds issued by TSMC, it also means that you lent $1,000 to TSMC. But the good thing of buying a bond instead of lend the money directly to TSMC is that when you hold the bond, you can sell it anytime in the secondary market. So then when you need the money, then you can get the money back, which means that with the introduction of a bond, it provides a higher liquidity for the debt instruments. And we like higher liquidity. There is something that I want to say here. It's about the ranking of your claiming right. Somehow when issuing bonds, they will give you the priority of your debt type. So then you can think about if a company have a value of $1,000, the company can issue bonds of $200, and that is called priority bonds, and then another $300, which is the regular bonds, and then the remaining $500 are the stocks. Then if somehow the company got bankrupt, then it's possible that the remaining value of the firm no longer equal to 1,000, which could be only 200. Then in that case, if you are buying the priority bonds, then you are going to get your money back first. Then for those people that buy the regular bonds, they are not going to get the money back because their ranking of the claiming right is after those people buying the priority bonds. So then what are the types of bonds? We can classify it by issuers. If it is classified by the issuers, it can be either issued by government or by corporate. If it is issued by government, we call it the government bonds. But in more detail, if it is issued by the central bank of the government, for example, for US, then we call it the treasury bonds. If it is issued by the city or local government of the US, then we call it the municipal municipal bonds. And another type of the bonds is called the corporate bonds, which are issued by firms. The bond type of government bonds can also be classified by time to maturity. If the time to maturity is more than 20 years, then we call it the treasury bond. If it is short, then, for example, less than 52 weeks, then we call it the treasury bill. And then for the maturity that is in between the short term and long term, we call it the treasury note. It can be more than 1 year but less than 20 years. For the corporate bonds, we can classify them by the default rate. For those corporate bonds that with low default rate, then we call it the investment level bonds. If the corporate bonds with a high default rate, then we call it junk bonds. So then you may ask the question, hey, wait a minute, we classify the corporate bonds by default rate. We do not classify the government bonds by default rate, but can the government bonds default? We will address this question in our live session. So given that for the corporate bonds, it has different level of the default rate. For those with low default rate, we call it the investment level bonds. And for those with high default rate, we call it the junk bonds. So how could we know which bonds are classified as investment level bonds and which bonds are classified as junk bonds? Some financial institutions help us to do that. One credit rating institute is called Moody's, and they classify the bonds by AAA, AAA, Baa, single A, B, Caa, Ca, and C. So then for the AAA bonds, it has the lowest default risk, and the bond with the C ranking, then it has the highest default risk. And we define the bonds that with the rating above and at the level of the Baa as the investment level bonds, and the bonds that are rated BA and below are called the junk bonds. Of course, there is more than one credit ranking institute, and another famous one is called S&P. They classify it by AAA, AA, single A, triple B, double B, single B, and triple C, double C, and single C. So under their ranking, again, the AAA bonds is the bond with the lowest default risk, and the bond with the single C is the bond with the highest default risk. So then again, we define the junk bond and the investment level bonds by cutting here. We say that the bonds with the rating at the level of triple B or above are the investment level bonds, and the bond with the rating BB and below are called the junk bonds. So this concludes the discussion related to the bonds.